So welcome everybody to the October webinar series put on by VR Mergers and Acquisitions here in Charlotte, North Carolina. Super happy to have you today. This is part of our mission. We really feel like we are in the business to help educate those who are contemplating an exit, whether it's a buyer of a business who's contemplating leaving their job and they want to buy a business, or on the other side, if it's a seller of a business who is contemplating their exit and wants to figure out how to get maximum value for their business when they are ready to exit. Super excited to have a longtime friend of VR and good personal friend, Jim Turner with Turner Business Appraisers here. And Jim, I'm not going to give you an introduction. I'm going to let you give a brief introduction so we can tell everybody who they're listening to today.
All right. Well, I appreciate it, Adam, for having me on board today. And as you all heard, we're going to be speaking about some exciting information today, some good topics here. Exit, contemplating your exit. So exit strategy, and also business drivers, values of business, or drivers of business value, I should say. And Adam didn't introduce me, so as he said, he was going to pass that baton over to me. So I will tell you just a little bit about myself. First of all, I'm about 5 years younger in that picture over to the side. So I've got a few gray hairs, a few more gray hairs. That happens. I also have a wife and two little fellas. I'm probably older than most people, with an 8-year-old and a 10-year-old. And as one lady at church said, she said, "Jim, you're going to be as old as Abraham was by the time your boys graduate from college." So, but I'm a business evaluator. I'm a certified public accountant. I'm a certified machinery and equipment appraiser. I'm a certified real estate broker. And I think that's all the certifications that I have at this point. But so I'm excited to talk to you today about what I've learned over the years in valuing businesses and in working with folks through mergers and acquisitions. So Adam, without further ado, we'll start that presentation up.
Let's get started. So before we do, a little bit of housekeeping here. These are our disclaimers. Everything we're talking about is for informational purposes only, but these concepts apply to the small business as well as the very large business. We are not here to give out any legal or accounting advice. We're here to talk about business concepts. So that is my disclaimer, and that keeps my attorney happy when I do this. So let's talk about value drivers and exit planning, Jim. You've got 3 bullet points over here, and let me be clear to those who are listening live or are watching later. Each one of these bullets could be a 90-minute session specifically, but what we've asked Jim to do is really, as evaluator, someone who's looking at businesses, what are the main drivers that he's looking at? And so, Jim, I'll let you sort of take it from here, and I'll jump in as needed.
Well, I appreciate that, Adam. So as Adam mentioned, there are 3 bullet points on the PowerPoint slide. There are also 3 icons, and each icon represents a point. And the first point that I'm going to talk about is cash flow is king. And I say it this way: cash flow is the value king with wings, because my icon was a dollar bill with wings. And so the old adage that cash is king is certainly true when it comes to business valuation. And the way I like to share this concept is, when you think about what's more important, revenue, is it cash flow, is it something else? I like to give an example. And imagine, if you will, that you're looking at 2 businesses. They're in the same industry. Let's just say they're CPA firms, since I'm a CPA. make it easy for CPA here. Let's say they're both doing $1 million a year in revenue, but CPA firm A is out of that $1 million in revenue converts $250,000 of it into cash flow. And then we've got CPA firm B also doing $1 million worth of revenue, but it only converts $100,000 a year in EBITDA cash flow. So which one would you pay more for? Even though the revenues are the same, I certainly wouldn't pay the same amount for the firm that's generating $100,000 in EBITDA as I would for the one generating $250,000 in EBITDA. So if you happen to hear folks, whether you're a buyer out there in the audience right now today, or whether you're a seller, if you happen to hear some anecdotal multiples, especially when they deal with revenue, I would just caution you to be maybe aware that revenue is not the best benchmark for value, and take those multiples that you hear with a grain of salt. So let's talk a little bit about cash flow. What do we mean by cash flow? The typical cash flow that we're talking about, the most common that we talk about as valuators and business brokers, and also in the business community, is earnings before interest, taxes, depreciation, and amortization. And you all have heard this referred to as EBITDA. So EBITDA is what I'll be referencing today when I talk about cash flow. There is another commonly used term, commonly used concept, especially with small business mergers and acquisitions, and that's called seller discretionary earnings, which is simply EBITDA plus one owner's compensation, and usually it's the highest compensated owner. So if you have more than one owner or shareholder, usually you're going to add EBITDA plus the highest paid officer to figure your seller discretionary earnings. So moving on, now we've established that cash flow is king, and I think we can all see from that example as to why it is a driver. Let's talk about the quality of cash flow. So going back to my example, you can have a CPA firm A that's generating $1 million in revenue and $250,000 in EBITDA, and you could have another firm generating the same $1 million in revenue and $250,000 in EBITDA, but the quality of the earnings might not be the same. And I'll give you an example. So let's say that one of those firms, firm A, is a regional accounting firm with 10 large audit clients and 250 federal corporate tax clients. So, and that's basically 260 clients. And let's say a majority or a good percentage of the revenue comes from those 10 audit clients. And then compare it to a second CPA firm, again, selling for, or that has $1 million worth of revenue and $250,000 worth of cash flow. Now, the second firm, let's consider that it has 750 tax clients and 500 monthly payroll and bookkeeping clients. So as you hear, as you listen to the examples, example one, firm one has basically 10 large audit clients and 250 federal corporate tax clients. If they lose, let's say 2 or 3 of those large audit clients, revenue could be impacted by, if each audit client is 5% of the revenue and you lose 3 of those clients, you could lose 15% of the revenue pretty quickly. if in the other example, let's say firm two, with 750 tax clients and 500 monthly payroll and bookkeeping clients, if they lose a few bookkeeping clients or a few tax clients, it's unlikely there's going to be a customer concentration. Another facet of this for both the firm one and two is that I like the stickiness of accounting firms. Accounting firms, we all have to have our federal tax return done once a year. In addition to that, firms that do audit work tend to be perennial, have perennial clients. Once you've done an audit one time for a firm, a financial audit, then more than likely you're going to continue to be the audit firm of choice, because there is a ramping up or an onboarding cost that occurs in year one that you don't have in year 2, 3, 4. So you're going to have a competitive advantage of continuing with that audit client. Another stickiness is this bookkeeping. So if you're doing a lot of monthly bookkeeping or quarterly and payroll, payroll has to be done at a minimum of quarterly. And the IRS mandates now that deposits be made more often than that. So, but quarterly payroll tax returns, 941s, 940s. And then at the end of the year, you have W-2s and for subcontractors, which are not payroll, but there's still something that, again, creates this stickiness. You have to create 1099s at the end of the year for certain subcontractors. So that speaks to the quality of earnings, those types of characteristics. I'll give you another.
Before you go on, let me just add one thing here. Let me just jump in, and I apologize, but what you're essentially saying is that you're, as a buyer who's going to look at this business someday, they're trying to minimize the risk that they're going to be buying. The cash flow that's being generated, where is that cash coming from? Is it coming from 5 or 10 big clients, or is it coming from hundreds of clients and lots of little clients that all add up? So if you lose one of the big 10, you're more vulnerable than if you lose one of the 100 over here on the other side. Is it? That's essentially what. And so as a evaluator, that's really important, where the revenue is coming from.
Yes, obviously the fewer customers you have that generate that revenue for that business, the more risk there is that one of those customers will leave and take a significant amount of cash flow. So that is absolutely true. And the second point of that same mode of thought is the fact that it's not just the number of customers, but also how sticky those customers, how sticky are they, is that cash flow. And again, the bookkeeping, the recurring revenue is really sticky. If anybody's ever tried to change CPA firms or payroll processing firms, you know that it's not so easy to transfer if you have employees, all their identification information, and also to get that in the middle of a quarter when you're already have a partial quarter accounted for. It's just very tedious and time consuming. So most people are not going to move these types of services without great thought, and they would have had to have experienced some main reason or big reason to move on. So that is true. I appreciate that insight, Adam, in making it, parsing down and making simple what I'm talking about here. Well, I'll give one more example. I'm currently helping some guys sell a landscape business that they own. And I don't do a lot of brokerage. That's VR, that's their bailiwick, but we do some. And I am helping this one customer sell their landscape business. And we found a buyer, and the buyer is willing to pay 5 times EBITDA for their recurring revenue accounts like homeowner association accounts, big accounts they have with corporate clients where they have contractual agreements set in place. So all the cash flow that we can identify that comes from those clients, they're willing to pay 5 times EBITDA for my seller. But for new construction, like when my client goes and they help Pulte build out a neighborhood and they do the landscaping for a new neighborhood, those kinds of new constructions, or if they came and built some outdoor hardscape somewhere, that's a one and done type scenario. And so this buyer is willing only to pay 3 times EBITDA for those construction type jobs. So again, we're speaking to the quality of earnings. So that's a big facet of cash flow. So we start with cash flow with EBITDA or seller discretionary earnings, but then we open up the hood, look under the hood and see, hey, what exactly is driving or pushing this cash flow? It's coming from the top down to the bottom line. Let's look at the top and get into the inside the engine and see what is driving the cash flow. And that's what we want to do when we talk about cash flow and quality of earnings. So the third point is your team. Your team is a driver of value. As a valuator, when I am valuing a business, I often ask for a organizational chart of the business, and because I also ask a lot of times who will stay on out of these key employees that will stay on after the seller departs and a new buyer comes in, a new owner comes in. And as a evaluator, I get some comfort out of knowing that there'll be 1 or 2 folks on board that already know what's going on. They've been there for a while. And it doesn't have to necessarily be an employee. I remember doing an evaluation recently of a general contractor, and he had about 6 subs that he had multi-year relationships with. And one sub would do one part of the construction, another sub would do another. And so I asked the owner of the business, I said, what are your relationships like with these subs? And how long have you been, basically, instead of giving me all your key employee information, give me your key sub information, because those subs have added some value to his business. He had that whoever buys that business, if it were to sell, they would look at that and want those relationships, and those relationships have value. So your team is valuable. I can't stress how much that human assets are the most valuable asset that you can have.
Jim, let me interject.
Yeah, sure.
Here on that comment here, because I think it's a really good one. Because Jim's talking about the role your team plays, and we advise our sellers not to tell their team that they're selling their business. So what I'm saying and what you're talking about are potentially contradictory things. You as a evaluator and as potentially as a buyer, you want to know who's going to stay, but I'm advocating for my seller not to tell them about the transaction until it's complete. So help me understand, if you were valuing a business that I was trying to sell, reconcile that, because we generally tell clients not to mention to their employees that it's for sale.
And I think that is a very wise advice, not to, to share that private information, because frankly, if you think about it, all businesses are for sale all the time. I mean, if you come offer me the right price, I might sell you my business today. And the same thing for Adam, even though we're not on the market actively. And so Adam brings up a good point. I don't want my colleagues to know that I'm for sale, and I'm really not formally for sale. Even if I were, though, like Adam has alluded to, that information is confidential. When I ask questions about the workforce, the organized labor force, especially key staff, I do so in a manner that I ask the stakeholder, the seller or a seller's representative, to just give me the position, not the name of the person, just the position, and a few other elements that will help me to ascertain the importance and the value of this particular position. It may be that person is for me, it may be a senior accountant, a senior tax auditor, or a senior evaluator. And that's all that I would need someone to know, or I would need to know as evaluator. And I may ask for the number of years, the tenure, like if they started in 2009 or 10 or 11, 15, whenever it was. And that kind of gives me, and I may ask for their duties as well. But again, I don't want the confidential information, as Adam said, because one of the quandaries or challenges that business brokers find themselves in, like Adam, is that businesses are one of those few assets that folks want to sell, but they don't want you to tell anybody about it. You know, you only want certain people to know. So it's not like Adam can get a sign and put it out in front of your business. Like, you don't have those luxuries when you're trying to sell a business. You're actually trying to hide it from most people, but only let a few people know. So that's a good point, Adam. Thanks for bringing that up.
Yeah, and Jim, before we go, I failed as a moderator of this webinar, and I'm human, but I forgot to invite anyone listening to ask us a question in the chat, or ask us a question in the Q&A, and I'll do my best to integrate that into the conversation. And we have one from my colleague up in Raleigh, Neil Isaacs with VR. He said, you talked about subs having value as opposed to, not a W-2 employee. I think that would surprise some people. So could you talk about that a little bit?
Well, let me circle back to the example I gave. It was a specific company that had a very unique business model. The general contractor was the only employee. He was the owner and the general contractor, and he had worked in Western North Carolina, around the Asheville area, for about 20 years as a general contractor for someone else, and had developed a kindred relationship with multiple subs when he was working for someone else. And when he started his own business, he knew 6 or so subs in different trades that he wanted to partner with. And so because he had that 20 years of experience working in that same market, these subs were very unique in that they were, he knew that they were the best, some of the best in Asheville, and he was able to bring them on board for his business, and he had multiple year relationships with them, with those subs. So I would not give much weight to a sub that was in and out, and not someone that or a sub that maybe doesn't have the reputation that these folks did. And also, I would want to see the ongoing relationship and the loyalty. These subs had a loyalty, and I asked the contractor, the owner of this particular business, multiple questions about the subs to get some sense of whether or not there was loyalty. And it
And of course,
wasn't.
that's industry specific, Jim, obviously.
Yeah,
So
it is.
I do want to keep this going because you have a lot of great material, and I'm going
Yeah.
to move it on to the next slide here because
Yeah.
we did promise to get people out here by 12:45, and I want to save some time for Q&A. So as we go on to the next slide, one of the things that, as evaluator, I know differentiation is really, really important. So if your example before, you have two accounting firms, but they are identical. Well, there might not be a lot of value difference, but talk a little bit about differentiating from a business valuator's perspective.
Well, I'm going to give another example because I love war stories. And so I was asked to value a saloon out west, a restaurant and saloon. This particular saloon was in a city where folks like Wyatt Earp and Virgil Earp and Doc Holliday had frequented. It was in Prescott, Arizona. And so had the pleasure of valuing this business that just because, and I had visited the business ironically like 2 years earlier. So I had been there. I had a friend that moved to Prescott, and he and his wife took me and my wife and my family there, and on a vacation. And so I was intimately familiar with the memorabilia that was inside of the saloon, and also the ambiance and the reputation. So this particular restaurant had intangible value in the memorabilia, even in the characters that came in there. There was a guy that came in there every day, and he was dressed fully decked out in a cowboy outfit. And so locals knew, and others who were visiting knew that this particular person would come in and and kind of entertain the patrons at this particular saloon. So that saloon, by the way, went back to the 1870s, and the oldest running, I think, saloon still in Arizona. It had always perpetually ran since the 1870s. So that is an example of a business that has some proprietary information or memorabilia. Even you don't often think of memorabilia as being a differentiator, but in this case it was, and the ambiance and the whole history behind of it. Another business that I'm familiar with, we did some work several years ago on a barbecue restaurant in eastern North Carolina. And, you'll often hear folks say, well, what's the secret sauce of your business? Well, this guy actually had a secret sauce, and he ended up selling it in Food Lion. So, if you've got something that differentiates you, we're definitely looking for it as valuators. So, anything that you can do to add value to your business. Another business that I valued, this is like 4 years ago, a local guy who started a business that scoops poop. And so he has contracts with homeowner associations, including the one I live in, where his business, he started this business like it was 15 years ago, as of the date of the valuation. And his motto, so even a slogan can have value because it was so clever. His motto was "Business stinks, but it's picking up."
I love it.
So, I would just say, I would encourage folks, when you're looking to buy a business, or if you're wanting to sell your business, to, document your intellectual property, your proprietary processes, your secret recipes. Obviously, if you have patents and copyrights, those are documented, but those are things that can help with value from an intellectual property perspective. So exit planning. I wanted to share a story, a really great story. Last year I helped a gentleman and his wife sell a business. This is another war story. And you know, when I look at folks who are wanting to sell, I think about, well, what are you going to do afterwards, and what kind of legacy do you want to leave? And again, I don't sell a lot of businesses like VR does, like Adam does, but at any rate, I think it's important that, you know, as business owners, we think about the legacy, and as a buyer, you think about what kind of legacy the seller is going to leave, and what that might look like. I'll tell you a story. I helped a guy and his wife sell a business, and they were helping folks through their church in Puerto Rico. There was a huge hurricane that hit there 3 or 4 years ago, and they had made numerous trips to Puerto Rico to help rebuild houses. And he wanted to get out of his business so he could go into that ministry full time. And so, but it was important to him. So number one was to move on and to go into something, take the fruits of his labor and move into something where he was receiving a calling from, let's say, a higher power. And then also he wanted his employees to be taken care of. So his legacy and his reputation. So we searched and we found, actually he found the buyer. The guy happened to walk in one day and say, hey, would you be interested in buying it? And long story short, the buyer was already in a similar business. So, you know, think about, as a seller, you know, what kind of legacy do you want to leave? What's that transition going to look like? And how do you want to leave that business? How do you want it to be remembered long term, and your own legacy as well? So
Jim, let me just add, when you know, exit planning literally could be a 5-day class. But when we get these calls from sellers of business, the first question we always ask them is, why are we having this conversation? So what I'm trying to do is understand the motivation, understand the timing. Did they just have a bad Thursday? Did they just lose a client? Are they just burnt out? Or are they really thinking, hey, I've been thinking about this for a couple of years. I've been preparing my financials. We've talked with our CPA. People are all over the spectrum. But I tell you that because that's the question we always ask. One of the next questions we always then ask our sellers and our prospects is, well, have you ever had your business valued? Do you have any idea what your business is worth? And I'm not asking them, and I'm very clear, I'm not asking them what they think they need for retirement. I'm asking them what they think the business is worth on the open market. And before you answer, you know, that business valuations, which you're an expert in, the answer I always get was, I need X. But they didn't answer the question. The question is, what do you think the business is worth? And their answer is always, well, I need X, or if I got Y, I would sell it. It's a very nuanced answer, but it's never answering the question, because in my opinion, and Jim, you are the professional valuation analyst and expert on this, most people don't know the value of their business. So Jim, it's on a tee there. People should get their business valued. Of course, they should reach out to Jim Turner at Turner Business Appraisers. I'm happy to plug Jim, because Jim is local and he's an expert. But talk a little bit about how often should an owner get their business valued?
Well, I think absolutely they need it valued when they begin to start to think about succession or exit planning. Personally, I think that you should have your business valued at the point where you believe that it's got value enough that it becomes an asset that is one of your your components of your retirement plan. It's a component of your estate. It's a component of your lifestyle. And the reason is because most of us know the value of all of our assets. I'm not an expert in real estate appraisal, but I can hop on Zillow or the local government website where my home is and my office, and I can look at the assessor's assessed value. I can look at Zillow and see what my house is supposedly worth. My vehicle, I have a good idea about that. Most assets, but probably the biggest asset for a lot of folks on this phone call, the sellers, and then the biggest asset for buyers that they might ever buy would be a business. And so I would say when your business becomes an integral part of your overall net worth, that's the time to get it valued. And I would say at least a year or two before you think you're going to exit. Now, if something comes up, if you go through what I call the 3Ds, disability, divorce, or death, you're going to have to get it valued at that point anyway. So, but don't let one of the 3Ds get you. Go ahead and get this large asset valued, because it should be part of your overall planning for your legacy, for your last will and testament, for familial planning for your wife if you have a spouse, and children, and so on and so forth. So I think we could, let me take a look at 1238. We could take some questions.
I want to echo before we do get, I want to echo what Jim said. And there's some real basic statistics, and I've read probably every survey, and directionally, most business owners have a tremendous amount, in excess of 50, usually closer to 75% or greater of their net worth tied up in a business, a private business, which is an illiquid asset, and very few truly know the value of their business. And so it's always staggering to me how many people, we go and talk to them, their business is worth $3 million, but it really only worth $1.5 million. And I mean, it's just, it's the responsible thing to do. To me, it's part of strategic planning, knowing the value of your business. You go in and you get a checkup with your doctor, you know what's going on with your body, your heart, your condition of your health. Well, this is your financial health. And so you need to make sure that you are regularly getting a checkup. We'll leave that up to you if it's annually or every other year or every 3 years, but you have to know what the business is worth so you can make the appropriate decisions on when is the time to exit. Do you have to work 5 or 10 more years? Do you have, would the proceeds after tax by working with your accountant enable you to live the type of lifestyle that is so important that people want in retirement? So it's really, really important. And I cannot tell you how few people actually truly know the value of the business. So if you're listening, you're a business owner, if you haven't had a business valued properly by a certified valuation expert like Jim, it's really, really worth it. It's going to surprise you, I'm sure. And maybe it'll surprise you on the positive side. I don't want to say that every business owner overvalues. There are some that, oh, it's worth $1 million. I only thought it was worth $500,000. And, then they have they can plan. And so they can, get that closer to the next stage of their life. So we do have a couple of questions here. Someone went back to the first sort of comments you made, Jim, and I want to bring it up again. Is talking about, and I'm going to stop share so people can see us here. Your first point was that buyers that owners should be focused on cash flow because that's what buyers buy. And you talked about cash flow as opposed to revenue. Well, I get told all the time by sellers of businesses, oh, we got 7 times revenue and we want to get, 3.2 times, trailing your future 12 months of revenue. And what I always tell people is you can't pay a mortgage with a top line revenue. You need cash flow. A bank is not going to loan you money. And they say, well, my buddy got 5 times revenue. Well, don't always listen to what your buddy said in terms of the terminology. Everyone likes to embellish a little bit on what they got for their business, but just go back to that comment was, I've always heard, the question was, I always hear it's a multiple of revenue. Now you're telling me it's a multiple of cash flow. Could you take that for a minute?
Yeah, I agree wholeheartedly with what you've said, Adam. I think that folks often hear stories, anecdotal evidence from different sources, whether it be a friend or a website or a blog or what have you. And I'm not quite certain, what metrics they're referring to often, because revenue, as I mentioned earlier, is not a good benchmark for the value of a business, and for the reasons you just mentioned, and for many more. And also, you need to know the terms that the deal sold under. What if your friend got 5 times revenue, but they had excess cash on the balance sheet of $1 million, and it was a stock deal, and the buyer got all the cash? They took the liabilities, but the liabilities weren't that much.
Right.
Well, and what if you've only got $50,000 worth of cash on your balance sheet? So revenue is not a good indication of value. I think that may be what happens sometimes, is folks get maybe the transaction is actually an equity purchase, and they have a lot of current assets on their balance sheet, and they're paid maybe a multiple of revenue that seems staggering to me. But otherwise, I mean, notwithstanding those examples I just gave, cash flow, is the driver. It is the driver. You may see revenue as a driver at first with publicly traded stocks. And I'll give you an example. Let's just go with Amazon. Up until maybe 15 years ago, Amazon never generated any EBITDA, any cash flow, but yet their stock was trading maybe for $100 a share 15 years ago. It's at now about $3,500 a share. And you might say, well, I see publicly traded stocks that never made a profit. How could revenue not be the driver? Well, the issue is this: the analysts for Morgan Stanley and for Goldman Sachs and Citibank and all the other analysts, they're doing discounted cash flow forecasts. They're not so concerned about the revenue. The revenue is all it's doing is it's reinforcing the fact that their discounted cash flow, which is a cash flow model, an income approach, is coming to fruition. And they'll see that.
Jim, we're getting a little into the weeds here, so I want to keep people back. So it's really cash flow. We're almost out of time. I have 2 quick questions that have popped up on the Q&A, and if we could give really quick answer to the first one, then I'll lead into the second one. The question is, if your business isn't worth enough, how long might it take to grow that business? Is 2 years enough? I.e., do they need to show, say that they're not making much today, from an evaluation and from potentially a buyers, do they need to show 1 year of good cash flow, 2 years, 3 years, and just a real quick answer, because I want to finish with one other topic.
I think there's no set amount of time, but certainly 2 years is I think a reasonable number. 3 would be even better. But more importantly is demonstration that cash flow is going to continue in the future.
Yeah, great. And then the next thing, and I'm going to bring you back up because it dovetails into the next question, if I can navigate this properly, which is, Now, how long does this take? What's the process for an owner? Do you need, so real quickly, Jim, talk, in 30 seconds or so, what does an owner need to provide a third-party evaluator like yourself, a business appraiser, so they can get the process started? And once you get that information, how long does it take to get a report with a stated value?
So the first part of the question, we typically ask for 3 years worth of business tax returns and 3 years worth of financial statements, the most recent 3, and then an interim for the current year. So an interim would be like a January 1st through October 31st, 2021 interim P&L, and then a balance sheet as of 10/31/2021. The second part of your question is, once we get that data, it takes about 2 to 4 weeks in order to analyze that data, send out another checklist of specific company questions, and then take all the data, including the tailored checklist of questions, and calibrate the valuation.
Great. Well, I purposely gave you the chance to talk about that while we put your information up there. If those of you who are interested in learning more about Jim and his services, his information is there. He's great. He's accredited. He's well respected by sellers in the community, by lenders in the community, by financial advisors, other professional advisors that you as the owner are going to work with. And it's great to have such a resource in our backyard here in Charlotte, North Carolina. The only thing I just wanted to end on is next month, continuing our series, our Contemplating Your Exit series, we'll have Jeff Haybrook, founder of Lucrum Consulting, and he will be talking about how to get your finances in order. And so once you get them in order, you can turn them over to Jim to do the proper valuation. But it's been a pleasure, Jim, to have you on here. You gave a tremendous amount of information. For those of you who are watching live, we'll send you the link if you want to go back and check something. And for those of you who are viewing this recorded, we're happy to help answer any additional questions for you. Jim, thank you so much for helping educate the community on what you do and the value you do. And for those of you out here, again, I'm going to end by saying, make sure you get your business valued on a regular basis for your financial health and for your ability to enter that next chapter on your terms, on your timing, when you are ready. Jim, thanks. Everybody, thank you for watching. See you next month on our Contemplating Your Exit webinar series. Thank you very much.